Hello, welcome back to smarthelping.com. I am doing a self-storage multi-fund model here. It's completely finished. It's one of the most extensive dashboard summaries I've ever done. It's got some really new, interesting and new logic for um, building out assumptions, showing that over a timeline, putting it into a um, joint venture waterfall, and then taking the results of that waterfall and putting it back on the same timeline and aggregating all that information. So it was a lot. I've live streamed the entire model build in the last 3 weeks. Now it's done. I just finished doing all the charts here recently this morning and all the summary data. So we're going to get into it here. I'm going to go through each tab so you know like what's going on and how to use it. And again, don't forget to subscribe. That helps. So let's go to the assumptions tab. So what this is self-storage, equity only. So all these deals, the idea is that you can, as an investor or a sponsor, you can see what it's like if you enter a deal, have some split for equity contribution, you have some uh, waterfall return for different IRR hurdles, and then you exit the deal, move on to the next one, and you can do up to six over a period of 15 years. So I felt like that was uh, I felt like that was enough time to really plan out such a investment strategy and or operating strategy if you're the sponsor. So you can enter the fund names up top here. That flows through the model. You only want to adjust the cells in light yellow. You'll start with the start of construction for the first fund, which you can pick the month, the length construction lasts, if applicable, revenue start. Note that this has to be at least one. It should never be zero. So no matter when the start month is, revenue always starts at minimum 1 month later. But you could adjust that to any month one or more. We have development construction costs if applicable, based on uh, some general assumptions that are relevant to self-storage, like square feet, how much of that's rentable, what's the cost of land. So here's land cost, here's a construction cost schedule. Um, you could also be purchasing an existing self-storage facility. In that case, you might want to see what the current NOI is, and at some cap rate, that's going to give you an acquisition cost. Maybe you have a reserve you want to keep, and then after all those are factored in, we have our total startup investment line here, and this is what's going to be split, if applicable, to the JV joint venture based on these splits here. Now, if let's say you were only a builder or a sponsor and you weren't going to get any investors, you could put 0% here. That's completely fine, and it just means that um, the GP for Fund 1 contributes 100% of the capital. As you can see here, 1,413,000, which is this number, and they get all the returns as well. Let's go back here, put this back to 80. And if you were just um, all an investor is going to contribute everything, you can put this to 100. And depending on how you structure the cash flow splits, it could be all, um, you know, some could still go to the GP or it could all go to the LP. If you, it essentially you can show only one side if you just want to see if there was no joint venture. You can adjust those accordingly. Okay, so that's the all-in equity required. We now have operating expenses. So this is I try to keep this simple so it's more of an analysis tool. So you got a cost per square foot of the facility per year. So this is saying it costs $4 a year. Um, and then there's some growth of that per year. And then also I separated out sales and marketing because that was actually a relevant line item. If you include the sales and marketing in this cost per square foot for OpEx, then you would just zero out the percentage here. Uh, and this is a percentage of gross revenue. Now the cost per square foot, so this $4, if you go over to, I have a pro forma for all 6 funds. So you can see like here's the equity required, total square feet, unit count. We haven't gotten to revenue yet. Sales and marketing, OpEx. So you can see here it's dividing, it's taking that number, um, figuring out if it's growing, like it grows 1% per year. So it figures out that uh, coefficient and it goes up every 12 months. And then you're dividing by 12 because that's the annual cost per square foot. And to figure out the annual cost per square foot, if you don't know this number, you just take the total square feet of the facility, and then you take the total expected operating cost for the year. Let's say it's, I don't know. Let's just see what we put in here for annual. In this case, it was so 288,000. So you would just do 288,000 divided by 12, or divided by your square feet of the deal, and that's what this number is. I just use this because it's more of a common term in the industry, but you can back into this however you want. Just put some number here. It's going to multiply. It's going to be um, define your total OpEx outside of sales and marketing based on how many square foot the building is. Then we've got revenue. So revenue is defined by a unit count. So self-storage, you have units. You have some occupancy. You can have an occupancy improvement, and you have a stabilized occupancy. So that means it starts at, in this case, 75%. Every month you improve it by 0.5 until it gets to 92, and then it's stabilized. And for fund one, you can see that happening here. So you can see 75 is going up by that rate. And then eventually, well, it's sold before you can actually stabilize in this case. But if we extended the months held, let's say we did it for 60 months on that one, um, you can see it gets up to 92 and then it maxes out. Now, I'll put this back to 24. Now the months you can manually define, but I try to make it easy so based on the months held, it has the exit, and then the next fund doesn't start until um, this number of months after the exit. Now this could be negative, so if like I just put this at 60 to hold, and then we go off the map for past 15 years, but then I could put, let's say, minus 54. And in that case, now we're back on the map, and now it starts, August 2022. So only about, starting essentially 12 months after this one started, and then while the first one's still running. So you can put negatives in here to show running multiple funds at one time instead of overlap, and instead of just doing one after the other. Now, the reason why I try to automate it for one after the other is the idea would be you have a certain amount of cash and you want to see what happens if you invest in one, exit, use that to invest in another one, exit without having to put in any more money. But you can put in more equity, and the monthly cash flows will handle that. It'll just be a negative value for the ending bank balance. And whatever that max negative value is, which is going to show right here, is going to show you how much money is required to um, never go negative as far as the bank balance. And you can see here if I put in the minimum 282,608, you can see my bank balance here. It never gets to below zero. And then over time it's growing as we keep scaling into new deals and exiting. I've never seen this done in a model, and I thought this kind of logic was super valuable and useful to anybody that's investing in self-storage. And really the infrastructure here for how we're doing the cash distributions and coming back, it probably is super relevant for all kinds of investment, real estate investment opportunities, because oftentimes you want to see what happens as you can scale up. Like you want to see what the cash flow looks like, what the equity requirements are, and in the context of doing joint ventures, within those deals. So this does all of that. Where were we? So we were in revenue. So you got units, you got occupancy. So the revenue is just a simple term. It's just the monthly revenue charged per unit. So essentially the monthly price. And then based on the square foot, it's going to tell you the max revenue per square foot per month. Based on, and that'd be like a full occupancy, and then per year. And these are just numbers that are kind of standard in the industry, so you can see based on your assumptions how your numbers match up. You can see all this does is take um, the total revenue per unit times the total units divided by how many square foot. And that's going to give you the monthly, and then you can annualize it by multiplying by 12. So in this case, each square foot of this uh, self-storage property is yielding $102 per month in top line revenue, $6.80 per year. So you can see if it's $6.80 per year in revenue and your costs are $4, there's some margin there. That's your profit, operating income, less whatever's going on with the sales and marketing. Uh, and then you've also got an annual percentage growth in revenue. Every 12 months, it'll grow whatever the start number is for each fund. And then exit assumptions, you can put how many months you're actually going to hold this deal for. The exit cap rate, which is going to be based on NOI. And then you've got the resulting sale price per square foot. This is a big metric here. And then you've got selling and other fees, so you get your net proceeds after that. And then how many months until the next fund starts from the end of this fund. And those are the assumptions. You can do that for all 6. And everything aggregates. You can see, like here's fund 1, fund 2, fund 3, fund 4. Oop, I gotta adjust the reference there. So what's this? D4, E4, F. This is G then for fund 4. H for fund 5, and then I for fund 6. And I've gone through and you can see how these don't start until the dates on the assumptions. So fund 6 is not starting until November 2032. And you can see that number right here. And then it is exiting on June 2036, which will go to fund 6. June 2036, there's your exit. So this is all dynamic. Everything, all 6 funds operate on a monthly timeline. That's the same timeline. And then that is all aggregated. You can see the monthly cash flows for the sponsor and investor here on the same timeline. You can see there it's scaling, 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 and then finally exit. The trick was taking this monthly data, putting it into a cash flow waterfall that made sense for the right period because the internal rate of return hurdles are dependent on the timing and the period. So each cash flow distribution waterfall had to be, um, you know, the right months up top here, but also have the right separation of time between cash going out and coming back. And because the dates are different for everyone, you can see we had to do some really clever logic. It involved some matrix tabs, making, you see here, all had to go out to 180 months to do these correctly, and that's how essentially this is like the key that takes the P&L over to the cash flow, and then allows the cash flow figures to flow back onto the same timeline in aggregate here, so we can see what happens. I like to see the bank balance scale, get all the internal rate of return for the deal, aggregate level. I also then summarize that. So now you can see on an annual basis, here's fund 1 happening, here's cash flow for fund 2, 3, 4, etc. based on all the different timing assumptions. And this is for the sponsor and this for the investor. So this is cash after going through all the hurdles for each side of the joint venture. I've also done a discounted cash flow analysis for every view. So this is the annual basis discounted cash flow analysis. Here's it on a monthly basis, which is the most accurate um, amount. And these monthly net present values and internal rate of returns are used with the XIRR function on our dashboard summaries. You've also got each deal on its own has its own discounted cash flow analysis, so you can see individually what that looks like for the sponsor and investor, and that's all dynamic and specific to each fund. Then we have, so that's all that. Dashboard, you can define the discount rate for those discount cash flow analysis summaries right here for the LP and GP, and you can see, let's say I put the LP to 15%. That's going to lower the NPV to 430,000. If I undo it, it's 576. So you can see the net present values based on the discount rates for every deal. What else we got here? So cash required per deal, total cash returned, ROI, uh, net present value we just said, and then internal rate of return as well for each. We also have lifetime internal rate of return. And then I have annual cash flow per deal, annual cash flow per deal investor. These charts were really cool. So what this shows you is the negative amount is how much cash you needed, or the given sponsor, so sponsor in this case needed to start the deal, and then all the positive values are the positive cash flow each year, and in total. So this kind of shows, okay, it took this much. Here's how much this returned. This required this much cash. This is the total return, and so on. And I did that for both the sponsor and the investor, and I thought that was a really cool chart to show by fund. This is also this is probably one of the best charts of the whole thing because this shows you on an aggregate basis for the sponsor and investor, whichever one you're looking at, whichever side. What's the starting cash flow? How are you scaling up? And then so you start with negative 200,000, you run, then you exit. So you have 600,000. You use some of that to get into a new deal, and then that exits you grow. And based on, and this is where you can really see like how much are you fully reinvesting everything, which means you would essentially go up here and then go back to zero and then go, and then your exit would probably be higher every time if you tried to get this to where you're using maximum capital. Um, but you would basically be structuring the deals so you could see how high you can get to if you fully reinvest, or if you want to keep some, withdraw some or whatever. This can allow for all of those strategies. And you'll be able to see the cash flows that are going on with each deal based on those assumptions. I thought that was this was a really cool visual for sponsor and investor to show how the scale, where are you starting and where are you ending, and how are you getting there? How much are you reinvesting? Then we've just got the charts for everything at the top: lifetime IRR, total cash return per deal, and equity type, ROI per deal, NPV, and internal rate of return. I just try to keep them all pretty uniform. Uh, okay, well that's it. I did put an instruction tab here just to help anybody that just starts. Don't forget, you can purchase this in the link below. It's going to be I'm only charging $45 for this thing. I feel like easily, if you want to duplicate this, it costs thousands and thousands of dollars of consultation work and just time to do if you're trying to do it yourself. So we'll charge you 45. I will list out all the vendor templates. Don't forget to check out smarthelping.com as well. I'll have it listed there, and that's about it. I'll see you on the next one.